To approve the minutes from last month, our last quarter.
Yes, we do. And now those should be on the screen now.
I hear a motion for approval. Any questions?
Anyway.
Yep.
Okay.
If you could just turn on your microphone there, the blue button. Right. Yep.
I second.
All right, the only other thing on our agenda here today is the performance, the rebalance that we have hard copies in front of us here. And I'll bring it up on the screen here. I'm gonna.
Everyone got a copy?
Yep.
Very good. We'll have, this is the report through the end of the third quarter. I can also kind of verbally give you an idea of October. October overall was obviously a positive month, at least from the equity side of things. As always, the front section has background on overall market environment, so I will skip that unless anybody is dying to run through that. If you go to Exhibit 1, this is the performance report. And as always, if you just flip to page 2, this is showing the market value at the end of September. So market value was 20,783,626. So as you can see, the various obviously allocations and cash flows during the preceding 3 months. So a little underweight fixed income, a little underweight US equities, and not a surprise, you as many other clients, investors out there, you're anything that's kind of on the private side of things is over target because that hasn't been subject to the whims of the market. So you are about 4.4% over target on principal. Obviously, that's been a very good place to be on the real estate side of things. And then Partners Group and the private equity a little bit overweight there as well. And that has weathered the storm so far overall. So I'll talk about real estate in a little bit. If you flip to page 5. So looking here, as always, you can see various starting points in time, what the market value was, net cash flow. Obviously, it's going to be a negative number there. That's money coming out of the fund for benefits and expenses, and then net investment change during those various time periods. Spoiler alert, the most recent time periods are going to be negative. Once you get beyond the 1 year, obviously the numbers slip back to positive. So let's jump ahead to 8 and 9. This is as always, your manager lineup and kind of what's going on. So September was really bad. Earlier in my charts, which I didn't show you, it's more kind of just trivia than anything else. We're not market timers. We're not in and out of markets with you guys. So historically, September has been the hardest month from the S&P 500. It's like the only month in the entire year where there's less than a 50% historical odds of beating the market, of being positive during the course of the month. So unfortunately, that came to fruition. October was very strong, which I'll talk to in a second. And then with today's market move, November has flipped positive as well from an equity standpoint of things. So for the quarter, I see fund was down 4.1 versus 4.1 benchmark. And then that additional number beneath that is your ranking. The lower the number, the better. So I know Ted's not here for me to say that relative performance matters in down markets. So I guess I can say that, but it does. And obviously compared to others that have well overshot this, you are protecting compared to everybody else out there. There's no one out there with a institutional defined benefit public pension plan that's looking at positive numbers today. That's just not how that works today. So year to date, fund is down 17.3 versus 17.5, and that number beneath that 17th percentile. So 83% of the public defined benefit plans less than $50 million are worse off so far. And you follow it across, obviously positive numbers come on there, and then you can see the rankings through time. So fixed income continues to be a drag in this year so far, historically bad drag. on the aggregate index. So 3.2 versus 4.8 for the quarter. So good protection based on the mix that you have in place there. Year to date, 14.4 versus 14.6, so a little closer to the overall benchmark and rankings, we're at the 73rd percentile or so. So kind of breaking things down. So you have your core fixed income. That's not going to deviate too much from the ag. Obviously, the goal is to beat that a little bit through time, but you're not going to be seeing positive returns against a negative benchmark there. Core plus, this likely will underperform in this most recent time period. Longer term, we would hope to see a boost from your returns. And if you look at that versus core fixed income, you do see that. High yield, you can see that actually had a pretty good quarter. Once again, relatively speaking, it was negative, but negative 0.9. Year to date, still negative, obviously negative 14. But for that particular quarter, we saw high yield hold up really well. Preferred securities also relative to the aggregate benchmark above. You see that's just protected compared to overall benchmark. So those are some main components. Plus your floating rate bond fund, which we didn't have the full quarter yet. Those bottom three helped you, really protect this particular quarter. So from fixed income land, obviously we're in a world of pain right now, but you look at the yield to worst on the aggregate index, it's basically over 5% at this point, meaning, if you were to just buy the fund today on a go forward basis, your expectations, would be in the positive 5% range, as all these new bonds that are being purchased are just inevitably being purchased with higher coupon rates. That's just fact of things. So U.S. equities, obviously you see a brutal September, but for the quarter, we're down 4.2 versus 4.5, ranked at 22nd percentile, and then kind of go down the list. Obviously, we're all indexed. Overall, you see Vanguard 500 was down 4.9. Mid cap value was 5.5. Mid cap growth was down 2.6. Small value 3.9, and then small growth was down negative 0.8 because of I believe it was July was such an up month overall with growth that I guess it skewed that particular quarter. Obviously today was a huge growth day. Anytime that the markets felt like the Fed would get some kind of a reason to slow down their interest rates, growth, everything just piled back into growth stocks. So that's what we're seeing obviously today. And I looked at the Fed meets in 33 days, I believe, again, and that's obviously the last one for the year. So looking at the odds after today's CPI number, which came in a little lower than expected, it's good. Once again, it's good news, bad news kind of deal. 83% odds right now, according to the Fed Watch tool, that they will raise 50 basis points as opposed to the 75 that they've been on. Flip to yesterday, that 83% was closer to about 57%. So, it bumped up the odds there. And you kind of look at, the headline numbers with inflation, it's a 12-month number. If you focus on that, the 1 year number, obviously the 12th month or the 13th month rolls off each month you go. So we were up against a 0.9 this month. So anything less than that was going to start knocking that 12-month number down. So that obviously brought it down to 7.7. Next month, the next number we're up against for November is a 0.7, and then a 0.6, then a 0.6. The next big number on the inflation that could possibly really help. We get what? February, yes, 1.2 is I'm sorry, March. March was 1.2. So as long as we get kind of reasonably high, I guess, inflation, we could start to see that number coming down and just give, I guess, comfort to people that are hyper focused on that 12-month number. I mean, still at the end of the day, prices are higher than last month across the board. That trend has continued. Used cars have come down. You see that was ridiculously high for a variety of reasons. Shelter was up again, 0.8. Shelter, while that's a huge component, it's a little fishy in how that's included in the actual CPI numbers. 2/3 of the shelter CPI number are households, and they would call people like you and I and say, what do you feel like you could rent your house for? And that number usually is pretty sticky. Do this exercise 3 years ago, 2 years ago, 4 years ago. probably pretty close. The best estimate was whatever it was the prior month. Like, you're not going to say that there's a huge increase. In the kind of euphoric real estate market we were in, everyone's saying, well, I could get more than I was last month if I were to rent my house out. So that number has kind of kept ticking higher. So as we see stress in real estate, this kind of estimated number likely should start to see some softness within there. Obviously, there still is the component of people paying actual rent, but there is a large part of this that is a guess. It's people's what they feel at that particular time. So sorry for the deviation there. If you're back in the book, top of page 9, non-US, nowhere really to hide for the quarter. You see for the quarter down 10.4 versus 10.1. Obviously, we also index here. You have the total international stock index, which was down 10.5. The small cap side of things was down 9.9, and then emerging markets were down 10.7. Basically, the only real country this year that's not some kind of outpost frontier country has been Brazil, of all places, and obviously there's a lot going on there right now, so that probably will shift at some point. But that has been really the only real EM developed market that's been positive this year. And you go back in the past few years, they were the worst performer of most countries. So it's kind of a unique situation for them. And then alternatives, you see for the quarter, principal was up a positive 0.4. You obviously look at the year-to-date numbers, the one-year numbers, which obviously skew things these past few years. We're starting to see, a more cautious real estate investment market. From a return standpoint, obviously you have your income and then you have your appreciation. So if you were to kind of boil this down there, the income is still there. We actually saw depreciation in the assessed values of the properties. There's just a disconnect. People that own the buildings don't want to sell it at the price that the people that want to buy the building. So we're kind of getting back into that mode. So principal is always, at least in time I've worked with them the past 8 or 9 years, has been, very kind of forward looking on trying to plan and set queues and all that. So they set a queue up last quarter, which is now we're seeing all other real estate managers kind of start to join the party there. So a queue meaning if we asked to pull some funds, they'd say, okay, sign the paperwork, get in line. And get in line meaning, might be a quarter or two or so. Looked at their incoming queue and outgoing queue. Actually incoming, they have about $560 million in their queue coming in. 500 of that is just one investor. And that investor basically said, we want one toe in, but we don't want to go all the way in yet. We want to kind of wait to see how things go. So that's kind of jamming some of their incoming outgoing funds. On the outgoing side of things, there's about $600 to $700 million that's in the queue to go out. So right now, things are just slow there because principal is trying to be measured, and obviously they have this big chunk of money. In a normal market, they've matched the money coming in, the money coming out without having to do any kind of dispositions of sales. So right now, it's kind of gummed up there. From private equity, you also see positive return, positive 1.9 for Partners Group for the quarter. Obviously, we do expect at some point, private equity will lag on public markets. We will expect to see some, can't guarantee you positive numbers if there's a bear market for another year or two, but obviously that helps. It helps returns right now. The next page is just historical returns. If you want to relive the good old days at the top there, that's there for you.
Oh, you don't have 2008 in there.
That's the beauty, you know this. At a certain point, you just run out of room on the page once it's far enough. I don't want to use size 5 font. So obviously, as always, you see various manager pages. If you skip to page 29, and maybe as long as it's looking at us, let me just talk about 28 for a second on principal. So this is kind of the current overall portfolio. Bottom half of the page, the lighter gray, I guess, shows you where their weightings are, and that darker gray on each one of those bar charts is the main private real estate index. You can see where they're making some bets. Underweight East Coast, a little heavier weight South, and a little heavier weight West. And then underweight Midwest. I mean, they're pretty transparent. They're overweight places where there's growth and where there's demographics that are favorable. And that's the bottom line there.
So they're betting on industrial.
Their big bet has been industrial. That has certainly paid off. When we kind of look at where we go from here, projections, which will obviously be wrong, and kind of where things are. Industrial still, even with obviously, plenty of building going on there, would still do appear that does appear to be probably the best place to be if you had to pick one in the next 5 years or so. Then from there, it's apartment, and then actually retail, and then finally office, from a return expectation standpoint. One of the things that they are working on is actually adding a little bit of strategic retail at the cost of probably underweighting office more, but it takes time. These things aren't done quickly. One of the things, early on, I asked, can't remember if it was these guys or somebody else, was, hearing discussions of attempting to convert offices to apartments. I was like, that sounds like a major undertaking. I said, yes, that it's nice to say you're going to do that or attempt to do that, but extremely costly there. So, anyone that's out there saying, oh, we can just convert all these to apartments, easier said than done. And that costs a lot of money, which then, as an investor, might not even make sense there. So that's not going to be the, likely the savior of the office markets.
Are we ahead or behind in the city on what people are doing with real estate?
It depends. We've had some that were well over 5% overweight just because of how they time things. And those 2 quarters ago, you're actually out of whack with your guidelines. So we started pulling. There's others that have, we're building different programs and we're underweight. I'd say you're probably, and you don't want to hear this, but you're probably right in the middle of that. I mean, you're close to your 5% guideline. So kind of my discussion to you all today will be, I don't have any recommendations to pull money from real estate. Like I said, it's not like we can snap our fingers and do it, but you're about $800,000 over target. That'll be less because of, today's market, but obviously those things swing, but perhaps consider maybe putting in some type of a real estate redemption. And obviously as interest rates have gone up, we won't get it till next year. Some clients are, we're doing asset allocation studies for some that we haven't done for years, and fixed income actually looks appealing. It might actually help as opposed to be a complete drag on your portfolio. So 29 just shows you fees, page 42 or 42 basis points overall versus 41. And you can see obviously our fee on there and then your total fees. So flipping over, it just shows you the market values as of like Halloween. And you can see about $21,335,333. This is my eye test page. So from there, estimating the fund was up about 2.7% during the month of October. Fixed income was down. Fixed income took a hit again, but equity indices were up 6, 7, 8, 9, almost 10% on some of those. So obviously that helped things. So that's a bump from there. Based on where we sit now, we're probably up another 0.5%, I guess, this month. So obviously we're still very much in the hole from what's happened this year. And you flip over, you can see, yep, thank you. You can see kind of where the benefit index sits at right now. I'm seeing about 1.5, a little over 1.5 million for cushion. No equity exposure. Again, as a reminder, you have fixed income and real estate. Real estate, according to their calculations, is the riskiest of the. Obviously, it's a liquidity factor, so there's not much liquidity in real estate. So that's all the way in the far right there. So that's kind of where things sit now. I'll flip back to that page that said October 31st. On the prior page, you go that plus minus column, which is the fifth one over. Obviously, we're always going to be over or underweight something. That's just the nature of the markets. But the biggest overweight, at least as of this, was that 836,000 to principal. So that if you're considering at least getting in line for that, I can tell you for sure by the time the next time we meet, you're not going to see those funds. That could be something we come to you at the next meeting and say, okay, if we take 300 or 400 or whatever it may be, cut that in half. We probably sprinkle that between fixed income and equities, depending on whatever the markets look like. When we meet again in 3 months.
We put ourselves in the queue, are we obligated to do it? Will they give us the option to pull out?
They generally, others are kind of, I don't want to say indifferent, but have more flexibility, but generally they want you to stick to that because they are more thoughtful in planning. So we would kind of be stuck with that decision. Not that that's a bad one.
Everyone go in the queue for, what would you say, half of it?
Maybe just trim your overweight by half, so at least you're getting closer.
Or do you go in the queue for the full amount, knowing you're not gonna get the full amount?
Or we just hold off until you get to that, where they can be with that amount?
So, yeah, it might be timing, it might be many quarters. So the assumption also is, to Mike's point, is, we're not gonna get it all in one swoop. You might get it, some in the second quarter, some in third quarter. It depends on, how crazy.
So you're better off lining up.
Get things in line. Then we know that's coming. Like I said, by that time, if interest rates even up another 0.5%, 1%, you got to make the trade-off on the liquidity of real estate and cover that market versus, hey, we can possibly get 5% in our core fixed income as kind of the bedrock of the program, and versus 6.5%, 7% in real estate. Obviously, a year ago, in prior years, it was easy math. It was like real estate. Let's overweight that, but things are evolving.
Like I say to clients, I say, normally your fixed income is your anchor. And it basically keeps the boat from bouncing around. I
Mhm.
said, in this environment, it's taking it under the water level, and now you're taking on water.
Yep. It's hurt. But at a certain point, once we come out of this, we'll wake
Right.
up to a whole new world.
You in favor of getting the queue for a portion of it? Personally, I mean, when you put the partners group with the real estate, you're at 20% of alts.
Yeah.
Right now. Personally, be in favor of. You're in for 400,000 or 500,000.
Yeah, I was gonna say 500,000.
Like I said, the question of where it goes, I can give a few scenarios when we meet again in, I think, February.
Okay, so the motion would be to approve the enter in the queue for it principal for 500,000. Is that right? But there'll be no, we'd have to meet again to get
Yes.
once that money arrives or to
Yeah, we'll
get an allocation, and that would be based on.
And we'll,
what
yeah,
the market is at
Marquette
that
will come
Okay.
back at the next meeting with recommendations, and see the world will be a little different probably in 3 months. So
Out of curiosity, at the bottom of the spreadsheet, the principal and Vanguard assets don't add up to 100%. You know why that is?
that is likely Partners Group. I don't even look at that chart, so it's probably,
Like 9.
yeah, it doesn't even, the total plan doesn't even equal that, so that's just bad math.
We hold principal at Fidelity, is that right? Where do we hold principal?
Principal is with.
I'm sorry, not principal, Partners Group, is that custody anymore? or
Partners
is it
Group is
direct
through,
with them?
is direct with
Okay.
Partners Group, yeah. Yeah, I'll get that. I'll get that chart fixed. I honestly didn't look at that.
You're doing those final notes there. We did have the Commerce as the custodian has been set up as at Commerce, I believe, right?
Regions.
Regents, okay,
Yep.
sorry, that was the other one. the other side.
Yep.
Yeah, Regents, so the custodial account set up, that's all in there, so we'll have to put those in those the fees that are coming there when they come in.
Yep.
I suppose, and then
And that gives us more flexibility to get outside of principal and Vanguard as well. So that's obviously Pacific is the first kind of entry in there. And how's that been so far working with them?
I haven't had to deal with them a lot.
Okay.
But usually I hear complaints and I haven't. heard
Actually, I
any
figured you
complaints.
probably
Yep.
hear about it, right?
Yeah, and so it's going smooth. I think it's been much more
Okay.
smooth to work with, getting it set up than as we had before.
If you wouldn't mind just checking the rebalancing sheet, just to make sure the calculation's right, because in
Okay.
the lower right too, it looks like the total asset mix is at 96.1%. Just to make sure the
Yeah.
recommendations are correct on that.
Yeah, the stuff on the left side, that is all. Up
I
until,
think it's your Pacific Bank loan.
So here's what I would
Isn't
suggest
isn't entering into the formula quite yet.
Yeah.
We added that.
Okay,
in.
that's
It's
it,
okay.
yeah, 837, okay. So the left column is correct.
sorry about that.
Left column.
October 31st, so the out of whack.
Yeah, those,
Is correct.
All right, so, got it.
Everyone's still comfortable with the 500,000 out of principal?
Yep.
Yeah.
so we'll work with staff to get that going. I will get these Excel formulas fixed behind this spreadsheet. And the next meeting, we'll have some recommendations on the 500.
And can you just speak to them also about just having the balance start to grow?
I'm sorry, have what?
Have the balance start to grow.
That's the goal, right? Obviously, so you think about, bear markets, kind of historically, I had some quick notes on here. So average bear market going back, basically Great Depression era and so on, it's been about 13 months in duration. So right now we're just started month 11. You go back to, .com crisis, that's, our lifetime's the longest. So that was about 30 months. Global financial crisis was what I got here.
What's a typical bull market though?
Longer. I don't have that, but I know longer.
I guess my point would be that I would think that our bear market could be worse because we had a very, very long bull market.
Yeah, I did a panel this morning or this afternoon downtown, and I was doing the equities, and last time I did that panel was in February of 2020. And I went back and kind of the preparation of that meeting and some of the notes and all that. And I go, here's the things we were talking about back then. How long can this bull market last? When will value finally outperform? When are valuations going to finally matter? And when are we finally going to get inflation with this robust economy? So obviously we got all those things. We wanted them at this point, but yeah, obviously we got a very long bull market, and you look at valuations, large cap historic valuations, obviously if the denominator, then it just keeps that story going. But large cap is closer to long term
Now,
yeah. I didn't include it in here because I know you guys don't want to get bored with that normally, but yeah, large cap is closer to norms. Mid cap and small cap overall are kind of overshot. So if you're purely looking at things from okay, what's a better value right now, maybe probably more of a 3 to 5 year basis, not a 3 to 5 week basis. Mid and small look better. You could have said that about non-US the past decade plus, and if you would have overweighted there, we've won some business because of people that did that on our side of things, because they were 60% non-US and they were getting killed. So there's no guarantee on those things, but in the full equation of thinking about things.
okay, thank you.
Mhm.
Else have any questions? Go ahead.
Any other questions?
All right, thanks.
Appreciate it. You get to go home in the dark. Thank you.
Thank you. I don't have any other business here if we want. I guess Mike Waite, he's retired from the city, so he can't represent us anymore. We'll be in the process of getting a new member there. Barb's out of town today, so she'll be back at the next meeting. The next meeting schedule would be February, is that right?
February 2nd.
Yes, the February 2nd. Yep. And then, that's all that I would have here. I don't know if, Councilmember Carl would like to give a city update, or if we would like to adjourn and, discuss that. If anyone needs to leave.
Why don't we adjourn and then you can discuss it. I move that we.
Move to adjourn.
Mhm.
Any
I'll second
seconds?
it. I second it.